Hey folks, today we're diving into some strategies for deciding when to buy and sell stocks based on technical analysis. Let's break down the top 5 techniques to help you navigate the stock market. First up, we have candlestick chart patterns. The Morningstar pattern is a great signal that a stock might rise after a downtrend. You can identify this pattern when you see a big red candle showing a drop, followed by a small neutral candle and ending with a big green candle indicating a potential rise. When considering when to buy, you have a couple of options. You can either buy when the third green candle completely covers the first red one, or wait until the third candle closes above the red one. It's important to place a stop loss at the lowest point of the neutral doji candle to minimize potential losses. On the other hand, the evening star pattern suggests a possible decline after an uptrend. You can recognize this pattern when you see a big green candle showing a rise, followed by a small neutral candle and ending with a big red candle suggesting a downward move. When deciding when to buy in this scenario, you can either buy when the third red candle covers the first green candle, or wait until the third candle closes well below the green one. It's essential to place a stop loss at the highest point of the neutral doji candle to manage risk effectively. Next, the head and shoulders pattern signals a potential drop after a rise. You can identify this pattern by looking for a left shoulder, a peak followed by a dip, a head, a higher peak than the left shoulder, a right shoulder, a peak similar to the left shoulder, and a neckline, a line drawn connecting the dips in the shoulders. When considering when to sell,
you should sell
when the price falls below the neckline and set a stop loss at the level of the right shoulder. Additionally, you can measure the distance from the neckline to the top of the head
and project it downward to
establish a target price. Finally, the inverted head and shoulders pattern suggests
a potential rise
after a drop. You can recognize this pattern by looking
for a left shoulder,
a trough followed by a rise, a head, a deeper trough than the left shoulder,
a right shoulder,
a trough similar to the left shoulder,
and a neckline,
a line drawn connecting the peaks of the shoulders. When deciding when to buy,
you should buy when the price rises above the neckline and set a stop loss at the level
of the right shoulder. Additionally, you can measure the distance from the neckline to the bottom of the head and project it upward to establish a target price. These techniques are valuable tools to help you make informed decisions when it comes to buying and selling stocks based on technical analysis. By understanding and applying these patterns, you can navigate the stock market with confidence. Happy trading? Are you looking to enhance your trading decisions and improve your success in the market? Look no further than the pivot point indicator. This powerful tool helps identify support and resistance levels, giving you an edge in your trading strategy. To use the pivot point indicator, simply add it to your chart and utilize the Fibonacci setting. This will allow you to accurately determine key levels that can guide your buying and selling decisions. The central level, known as the pivot point, P, serves as a pivotal point of reference. Above the pivot point, you'll find the resistance levels R1, R2, R3, which represent levels of potential price increase. Conversely, below the pivot point, you'll find the support levels S1, S2, S3, which indicate levels of potential price decrease. When it comes to timing your trades, the pivot point indicator can provide valuable insights. If the price holds above the pivot and shows strong upward movement, it may be an opportune time to buy. This indicates that support levels are holding up well and the stock has potential for further growth. Another useful tool for traders is the Relative Strength Index, RSI, which helps determine if a stock is overbought or oversold. By utilizing RSI with levels of 70 overbought and 30 oversold, or adjusting to 60 and 40, you can make more informed buying and selling decisions. Consider buying when the RSI crosses above 60, as this indicates that the stock is gaining strength. On the other hand, if the RSI approaches 80, it may be a sign that the stock is becoming overvalued, and it could be a good time to sell. For even better trading decisions, you can combine the pivot point indicator RSI, and volume indicators. This comprehensive strategy involves waiting for certain conditions to align before entering a trade. First, ensure that the RSI crosses above 60 for confirmation of strength. Additionally, look for volume to be at its highest in the last few days, indicating increased activity and potential market interest. Finally, the price should break above the pivot and move towards the first resistance level, R1. If all these conditions are met, you can have more confidence in your trade. To further enhance your skills and understanding, it is advisable to take a detailed technical analysis course. This will allow you to delve deeper into these strategies and become more proficient in using them. Remember, combining multiple indicators can significantly improve your trading success. As with any skill, practice and refinement are key. So keep experimenting and fine-tuning your approach. Feel free to share this valuable information with your friends and family who might benefit from it. Happy trading!